Let's talk about when the IRS finally comes knocking. RMDs, required minimum distributions, are one of the least exciting parts of retirement, but ignoring them, that can be costly. If you've saved in IRAs or 401ks over the years, the IRS eventually wants their share. And that means starting at age 73, you'll be required to take out a certain amount each year, whether you need the income or not. Let's walk through what RMDs are, how they work, and a few smart ways to plan around them. So what is an RMD? The required beginning age for RMDs has increased over time, most recently from age 70 and a half to 72 and now to 73. It's expected to increase again to 75 in the coming years. So staying current on the rules is important, especially if you're approaching retirement. At age 73, the IRS requires you to begin withdrawing from tax-deferred retirement accounts like traditional IRAs and 401ks. These withdrawals are called required minimum distributions, or RMDs. The only exception is if you're still actively employed and the funds are in an employee-sponsored plan like a 401k. In that case, RMDs can be delayed from that specific account. The amount you have to withdraw each year is based on two things: the value of your account on December 31st of the prior year and a divisor based on life expectancy published by the IRS. That translates to a withdrawal percentage that typically starts just under 4% of your total tax-deferred balances at age 73 and increases over time, growing much higher later in life. If you miss an RMD, there's a penalty, up to 25% of the amount you should have taken. So this is an option. Inherited accounts like IRAs or employer plans have similar rules, but with different timelines and distribution methods. It's important to get those right too. The good news, with some proactive planning, these rules don't have to catch you off guard. RMDs are treated as ordinary income. That means they're taxable. And if you're not careful, they can push you into a higher tax bracket, increase your Medicare premiums, and reduce eligibility for tax credits. Many retirees are surprised when their tax bill jumps in their mid-70s, especially if they're also receiving Social Security or pension income. Suddenly, all those tax-deferred dollars are catching up to you. So how do we plan ahead? There are a few strategies to help minimize the tax impact. One is Roth conversions before RMDs begin. Converting a portion of your IRA to a Roth before age 73 can reduce the size of your future RMDs. We cover this in detail in another video. Qualified charitable distributions, or QCDs. Once you're over 70 and a half, you can donate up to $100,000 per year directly from your IRA to charity. This satisfies your RMD and keeps it off your tax return. Multi-year planning. Rather than waiting until RMDs start, we help clients look 5 to 10 years out. That means coordinating income sources, timing Social Security, and balancing withdrawals from Roth, taxable, and IRA accounts. If you're already taking RMDs, it's about being strategic with each year's withdrawal. Another important step is coordinating between your different retirement accounts. Many retirees have multiple IRAs or 401ks scattered across old employers and other financial institutions. That can make RMDs harder to track and easier to miss. We often help clients consolidate their accounts in retirement. It doesn't just simplify reporting, it makes planning more effective. With a clear view of all of your assets in one place, you can better manage withdrawal strategies, cash flow timing, and long-term tax exposure. You can time your RMDs early in the year or spread it out across the year for your cash flow planning. You can pair it with charitable giving. You can reinvest it into another account if you don't need the income. We run these numbers every year for our clients, looking at not just what's required, but what's optimal. RMDs are unavoidable, but with the right strategy, they don't have to be painful.